Gold is falling during a war. Two separate wars, actually. Inflation is still above target. Global debt just hit another record, and the US government is borrowing over $1 trillion every 100 days. So why is gold down nearly 8% from its recent high? Most people will tell you it is the dollar. A stronger dollar means lower gold. That is true, but it is not the real story. That explanation misses the mechanism entirely. And when you miss the mechanism, you make the wrong decision at exactly the wrong time. Here is what is actually happening. The Federal Reserve is not confused. It is not waiting for more data. It is not carefully calibrating some soft landing. The Fed is paralyzed, not indecisive, paralyzed. There is a difference. Indecision means you have choices. Paralysis means every move breaks something different. Raise rates and the debt market cracks. Lower rates and inflation reignites. Stay still and the economy bleeds out slowly. Markets feel this before they understand it. Gold feels it first. What you are watching right now is not gold failing as a safe haven. What you are watching is the price discovery mechanism trying to figure out which way the Fed finally breaks. And most investors are asking the wrong question entirely. By the end of this breakdown, you will understand three things that almost no one is explaining correctly. First, you will understand exactly why the Fed cannot raise rates, cannot cut rates, and cannot stay where it is. I will show you the mathematical trap, not the commentary. Second, you will understand what actually happens to gold when a central bank enters this kind of paralysis. Not what the headlines say, what the historical mechanism says. And third, you will walk away with 4 specific indicators you can watch yourself. Numbers, thresholds, signals. The kind of data that tells you the trap is about to break before the price moves. If you value this kind of system-level analysis before it becomes consensus, subscribe now. This channel exists for exactly this kind of conversation. Now let me show you what is really happening. Let me start with the puzzle that confuses most investors. Gold peaked near $2,085 in early December. Since then, it has drifted lower. Not a crash. A slow, grinding decline. Meanwhile, the 10-year Treasury yield has moved sideways. The dollar index is up modestly. Real yields, inflation-adjusted yields on government bonds, have actually risen a little. That last point matters more than anything else. In the short run, gold trades like a currency. More precisely, it trades inversely to real yields. When real yields go up, gold tends to go down, because gold pays no yield. If you can get a safe 2.5% real return from a treasury bond, gold becomes less attractive by comparison. That is the simple story. And it is technically correct, but it is dangerously incomplete. Here is what the simple story leaves out. Real yields are not moving because the Fed is making a clean choice. They are moving because the bond market is trying to guess which way a paralyzed central bank finally breaks. Let me be precise. In a normal environment, the Fed has room. It can cut rates when growth slows. It can raise rates when inflation rises. It can communicate a clear path and markets price accordingly. That is not where we are. Today, inflation is running above 3% on most measures. Core inflation has been stuck between 3 and 4% for over a year. The labor market is softening but not breaking. Growth is slowing but not contracting. If this were the 1990s, the Fed would hold steady, maybe cut a little, no drama. But this is not the 1990s, because debt is not the 1990s. Total U.S. debt is now over $34 trillion. Federal debt alone is approaching 120% of GDP. Every 1 percentage point rise in interest rates adds roughly $340 billion in annual interest costs. That is not a fiscal problem. That is a structural constraint on monetary policy. So here is the trap. If the Fed raises rates again to kill inflation, completely, the debt service costs explode. The Treasury market cracks. Regional banks break again. That is one door. If the Fed cuts rates to relieve the economy, inflation reaccelerates. The dollar weakens. Imported inflation returns. And the Fed loses all credibility. That is the second door. If the Fed does nothing, the economy continues slowing. Recession becomes more likely. And the market forces a cut anyway, but from a position of panic rather than planning. Three doors. Every single one leads to pain. That is paralysis. And gold is sitting right in the middle of it, trying to price a future that even the Fed cannot see clearly. Now let me walk you through exactly how this trap works, step by step. Because once you see the mechanism, the price action in gold stops looking random and starts looking predictable. Step 1. Understand what actually drives gold in the short run. Most people think gold moves on inflation or fear. That is true over long cycles. But over weeks and months, gold moves on real yields. Specifically, the 10-year Treasury inflation-protected securities yield. When real yields rise, gold falls. When real yields fall, gold rises. This relationship has held for 25 years. It is not a theory. It is a market fact. Right now, real yields are hovering near 2%. That is high by historical standards. From 2012 to 2020, real yields were mostly negative or near zero. Gold had a massive bull run. From 2021 to 2023, real yields spiked to 2% or higher. Gold went sideways and down. So the current weakness in gold is mechanically explained. Real yields are high. Gold is responding. But here is where the story changes. Step 2, real yields are not a choice. They are a trap. Real yields are composed of two things: nominal yields minus inflation expectations. The Fed controls nominal yields indirectly, but inflation expectations are not cooperating. The market expects inflation to stay above 3% for years, not because of war, not because of supply chains, because of structural forces, deglobalization, aging demographics, the green transition, and a government that has normalized trillion-dollar deficits. So here is the trap. To lower real yields and make gold rise again, the Fed would need to cut nominal rates faster than inflation falls. But cutting nominal rates hard would reignite inflation immediately. The bond market would punish them. The dollar would crash. Gold would spike, yes, but in a panic way, not an orderly way. To raise real yields further and crush gold completely, the Fed would need to raise nominal rates again. But the debt cannot handle it. The banking system cannot handle it. The commercial real estate market cannot handle it. Step 3, write this down. The Fed is trapped between inflation that will not die and a debt system that cannot breathe. That is not a policy problem. That is a regime problem. Step 4, hi Kanal. How the trap breaks historically. I have watched markets for over 40 years, and I have seen this configuration before. Not exactly the same, but close enough to recognize the pattern. In the 1970s, the Fed was trapped between inflation and recession. They would raise rates. Inflation would pause. Then they would cut. Inflation would roar back. Each cycle, inflation bottomed higher than the last. Each cycle, gold made a higher low. The trap broke only when Paul Volcker raised rates so high that he broke the economy first and inflation second. That took real yields to 8%. Gold crashed temporarily. Then gold exploded as the dollar collapsed. Today, the debt load is 10 times larger relative to GDP. The Fed cannot do the Volcker solution. The system would shatter. So the trap breaks differently. It breaks when the market forces the Fed's hand. Either a debt crisis forces a cut regardless of inflation, or a currency crisis forces a hike regardless of debt, or something else breaks first. A bank, a sovereign, a commodities shock. Step 5. What that means for gold right now. Gold is not broken. Gold is waiting. The price is being held down by a paralyzed Fed and real yields that are artificially high relative to the underlying fiscal reality. But the moment the trap breaks, the moment the market decides which door opens, gold will reprice violently. If the Fed is forced to cut into high inflation, gold goes vertical. If the Fed is forced to hike into a recession, gold crashes first, then explodes later. Either path leads to a higher gold price over time. But the timing and the volatility are completely different. That is why most investors are misreading this. And that is what I want to show you next. Let me debunk 3 myths that are costing investors right now. Myth 1. Gold is crashing because the dollar is strong. This is true but incomplete. Yes, the dollar index is elevated. Yes, gold and the dollar usually move inversely, but the dollar is strong for the wrong reason. The dollar is strong because the rest of the world looks worse, not because the US looks good. Europe is in stagnation. China is fighting deflation. Japan is intervening in its currency. A strong dollar built on relative weakness is fragile. The moment sentiment shifts, the dollar can fall fast. And gold does not need the dollar to crash. It only needs the dollar to stop rising. That is a much lower bar. Myth 2. The Fed will pivot and save everything. This is the most dangerous belief in markets today. The Fed pivot narrative has been wrong for 18 months. Every time markets price in aggressive cuts, inflation data arrives hotter and the cuts get pushed out. The Fed cannot pivot aggressively because inflation is still above target. A real pivot, 50 to 100 basis points of cuts, would send the 10-year yield lower, the dollar lower, and gold much higher. The Fed knows this, and the Fed fears this, because a gold spike would signal a loss of confidence in the dollar. The Fed will wait until something breaks, not before. Myth 3. Gold is no longer a hedge. This one makes me shake my head. People see gold down 8% during wars and conclude it failed. That is confusing price volatility with the breakdown of a relationship. Gold is a hedge against 2 things: monetary debasement and systemic crisis. Neither has arrived yet. The debasement is coming. The crisis is coming. But they are not here. What we are in right now is the lull, the calm before the mechanism finishes playing out. In 2008, gold fell 40% from peak to trough during the worst of the liquidity crisis. Then it went on to triple over the next 3 years. The hedge did not fail. The timing was just different than people expected. Stay with me, because understanding this timing difference is the difference between panic selling and patient accumulation. What the headlines are missing. The headlines say gold is weak. The headlines say the Fed is in control. The headlines say the dollar is unshakable. The mechanism says something else. It says the Fed is trapped. It says gold is coiling. And it says most retail investors are looking at the price while smart money is watching the structural indicators, which is exactly where we go next. Now zoom out with me, because if you only look at the last 6 months, gold looks confused. If you look at the last 50 years, gold looks inevitable. Let me take you to 1973. Richard Nixon had closed the gold window 2 years earlier. The Bretton Woods system was dead. The dollar was floating, and the Fed was about to discover something terrifying. They had no idea how to manage an economy without a gold anchor. Inflation was rising. Oil shocks hit. The Fed raised rates. The economy slowed. They cut rates. Inflation exploded. From 1973 to 1979, the Fed went through cycle after cycle of tightening and easing. Each time, inflation bottomed higher than the last. Each time, the dollar lost more ground. And gold? Gold went from $42 an ounce to over $800. That is not a hedge. That is a wealth transfer. Here is what most people forget. Gold did not go up in a straight line. It had brutal corrections. In 1974 alone, gold fell nearly 50% from its high. Investors who panicked sold at the exact wrong moment. Investors who understood the mechanism held. Now compare that to today. We have the same core dynamic. The Fed is trapped between inflation and recession. But today we have three accelerants that did not exist in the 1970s. Accelerant 1, debt. In 1973, total U.S. debt was roughly 150% of GDP. Today, it is approaching 350%. That means the Fed has almost no room to raise rates without breaking the system. The 1970s Fed had room. They used it. This Fed does not. Accelerant 2, central bank behavior. In the 1970s, Western central banks were net sellers of gold. They did not trust it. Today, non-Western central banks are buying gold at the fastest pace since 1967. China, Russia, India, Turkey, Poland. They are diversifying away from the dollar. Quietly, relentlessly. That buying creates a floor under gold that did not exist 50 years ago. Accelerant 3, the reserve currency question. In the 1970s, the dollar was challenged but not seriously threatened. The petrodollar system was just being built. Today, that system is fraying. Oil is being priced in yuan. BRICS is talking about a gold-backed settlement currency. Saudi Arabia is signaling openness to non-dollar transactions. The dollar's exorbitant privilege is not gone, but it is in play. Now here is where this gets important. The 1970s gold bull run lasted 10 years and delivered a 2,300% return. The structural setup today is similar but more extreme. More debt, more central bank buying, more geopolitical fragmentation. That does not mean gold will repeat that performance. It means the mechanism is intact and the pressures are larger. What breaks the trap? Historically, it was a credibility event. Volcker broke the inflation psychology by raising rates to 20%. That killed inflation temporarily, but it also destroyed the bond market and set up the 1980s dollar crash. Today, the credibility event will look different. It will be the moment the market realizes the Fed cannot save the dollar and the economy at the same time. When that moment arrives, gold will not ask for permission. It will reprice. Let me give you 4 specific indicators. These are the numbers I watch. They will tell you the trap is breaking before gold makes its big move. Indicator 1, the 10-year real yield above 2.5%. Right now, real yields are near 2%. If they rise above 2.5% and hold, the Fed is being forced to tighten further. That is the hike into recession door. Gold would fall first. Watch for a false breakdown. That would be the buying opportunity. Indicator 2, gold lease rates and backwardation. This is the institutional signal most retail investors miss. Gold lease rates are the interest rate paid to borrow physical gold. When lease rates spike, it means physical gold is hard to find. When futures trade below spot, backwardation, the paper market is failing. That is a COMEX stress signal. If you see that, the physical repricing has already started. Indicator 3, bank funding stress. Watch the SOFR rate, the secured overnight financing rate. If SOFR spikes above the Fed's target range, something is breaking in the banking system. The last 2 times that happened, the Fed intervened within days. A SOFR spike would force the Fed's hand. Gold would react immediately. Indicator 4, non-Western central bank buying. The World Gold Council releases data monthly. Watch for sustained buying above 40 tons per month. That is the threshold where Eastern central banks are signaling they no longer trust Western monetary management. When that number accelerates, gold's long-term floor rises. Write those 4 down: 10-year real yield, gold lease rates, SOFR spikes, central bank buying. Those 4 indicators will tell you everything the headlines will not. So here is where we are. The Fed is paralyzed, not because they are incompetent, because the math no longer works. They cannot raise, they cannot cut, they cannot stay still. And every day they wait, the pressure builds on all three doors. Gold is not broken. Gold is waiting. The price action you are seeing right now is not a rejection of gold as money. It is the market trying to price a future the Fed refuses to acknowledge. Most investors will watch gold drift lower and conclude the story is over. They will sell, they will move on, and 3 years from now they will wonder why they did not see it coming. The mechanism is clear, the trap is real, and the break is coming. The only question is which door opens first. Inflation break, debt break, dollar break. One of them will give, and when it does, gold will not send you a polite invitation. It will move faster than most portfolios are positioned for. I've seen this pattern before, not exactly the same, but close enough to recognize the shape. The question is not whether gold will work. The question is whether you will recognize the moment before it happens. Stay patient, stay informed, and watch the indicators.